Yo, 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 yo! Welcome back, guys, to another Thompson 2 Cents Live. I'll be the guy on the mic, Larry Thompson, resident CMT. Going to be covering some charts today, covering the week in the market. I'll keep my comments about the Chiefs beating up on the Chargers tonight to a minimum. But the takeaway today will just be using the market to get our opinion, using the market to guide our decision making, not the opinions of men. Right? I think the market is the collective wisdom of all those investors. That's what technical analysis is rooted in, is that price holds wisdom, that market price action has wisdom within it. And so going through the CMT curriculum, right, studying and reading all these books behind me, the point in doing that was to become literate in the language of the market, which is charts and price action. Then once we become literate, the goal is to then align with the market, right? There's no reason to fight the market. There's plenty of people who will do that. Our goal is to align with the message of the market so we can make money, right? That's trend following to a degree, but it's also rotation trades. It's things that it's not fighting the price action and what it's telling us. So this was a big week in the market, headlines around inflation, headlines around jobs numbers, but let's dig into the charts and what the market is telling us, because that's the message that's the most important, and that's the one that pays us. So getting started here with the chart we look at every week, right? When you are building a process involves repetitive things. And this is one chart I like to take a look at every week. We're seeing the S&P 500 up week, right? Nothing crazy and special, but it still finished the week up. You actually see that a lot if you study bull markets, is that some weeks it's just getting that win, right? Getting that up week, grinding higher. Like the Eagles, right? They just find a way to win. They don't have to win by a lot. They find a way to win. Chiefs, they don't cover the spread often, but they find a way to win. And bull markets do that. They solve problems and they find ways to win. Still have RSI in the bullish range above 65 on the weekly. We have the S&P members above their 200-day, above 60. So the message in the market right now is don't fight the uptrend. Understand the bull market has the ability to solve problems and don't anticipate the problems. There will always be a story around the economy. There will always be a story around jobs. There'll be a story around sentiment. But price is telling us right now, stay the course. Be opportunistic. Look for good risk reward to take trades in. So general overview, chart we look at every week, seeing similar play out from that V bottom that we had in 2020 to now, and we're kind of entering that sustained uptrend phase. We'll see how that plays out because price will let us know if there's issues. But for now, looking pretty good. Next chart I wanted to look at is home builders, right? So if we're going to listen to the message of the market, there's charts within that are interest rate sensitive, that are cyclical, that are consumer sensitive. We can look at these individual charts to understand what's going on. We don't have to listen to new housing starts or anecdotal evidence from your aunt who's a realtor about how tough the housing market is, right? We can look at home builders and home construction ETFs, right? So we have ITB and XHB in this panel above me. And what we had earlier in the years, we had RSI divergence and then we saw follow through. I've been talking about this chart for a while. That follow through led to a regime change, right? It led to a trend change. And now you'll see with the RSI, we had that oversold and then we hit 30 and then bounced and we made those higher lows while price was making lower lows, right? That was a signal that there was exhaustion in sellers. Now we're seeing a sustained uptrend with bullish RSI regime, RSI staying in that range of, 50 to 70. Some would even call it like 40 to 70, right? Staying above 40, right? And using 50 as support instead of that being resistance. When you see that trend change, that's the market telling us that, one, interest rates may need to come lower. Two, home builders are doing okay, maybe because of interest rates. Or three, the consumer's all right? Like the consumer is going to have the ability to buy homes that the home builders are building, right? And so one of the reasons we look at this home construction and home builders ETF is just think about the flows of housing in America, right? We're huge consumers, and when you buy a house, you buy furniture, right? You have pest control. There's so many costs associated with buying homes, which is why a lot of people will tell you, personal finance people will tell you, See your home as an investment prop, like an investment, right? It is in your family, but it's not from an ROI perspective because by the time you paint, redo the flooring, redo the kitchen, right, the maintenance, etc., is consumerism. It's us spending money in the economy. And so this chart, right, listening to that message of the market, this chart tells us and shows us the importance of home builders relative to the market. I also have semiconductors on here because of the cyclicality and consumer sensitivity and economic sensitivity that semiconductors have. So you see here, right, we talked about listening to the message of the market, right? And we talked about how price will let us know. So you see sustained uptrend confirmation, right? Using the purple and red flowing together with the yellow and gold. And then what do we see to start the year? We saw home builders actually start to break down while semiconductors and the S&P 500 went sideways. So home builders were giving us a warning sign early to start the year. They peaked before everything else. Price gave us time. It gave us information. Price will let us know. The message of the market will let us know, and home builders tends to be one of those areas. Then when we started to rocket off the bottom, the question was home builders going to follow? And now we're seeing home builders follow through and catch up to semiconductors and the S&P 500. So the message in the market right now is confirmation of strength underneath the surface. Maybe the Fed cutting at the right time, making the right decision, despite what common folk may think. Sentiment that is in the dumps in some aspects, not being fitting for what the message of the market is. That's why we got into technicals. That's why we follow price, because we don't have to worry about listening to some guy with a PhD circumvent a process because he's fallible. Next chart I wanted to look at. Message in the market, biotechs, right? You can lump small caps into this in general, right? So you can look at IWM if you guys want to pull that chart up over your weekend review. But I'll just use biotechs, right? This is composed of 250 biotech stocks, and we're making year-to-date highs, right? We're making year-to-date highs today, up almost 2% today, biotechs, which is a speculative area of the market, an area of the market. People will say, well, it's interest rate sensitive. Sure, but it's also economically sensitive. If rates are zero, right, or rates are coming down, right, it's not that rates are going to zero, rates are coming down. If you still have a business that isn't viable or working well, you're not going to be rewarded. And biotechs have underperformed in those instances in the past. So them making year-to-date highs, at the very least, it's a sign that people are taking risk in the market and that the market is rewarding it. Market is saying, okay, you can take some risk here in biotechs, and it's rewarding that risk. So a chart like biotechs, a chart like small caps, you can even look at IWC. IWC is microcaps. You can look at microcaps, year-to-date highs also. This area of the market expanding, right? You're seeing breadth expansion underneath the surface. That's bullish. The market doesn't do that before breakdowns. We'll see breadth deteriorate before breakdowns. We'll see home builders roll over before breakdowns. We won't see the price action we're currently seeing, right? I know some stocks were down today on a Friday. It can be scary heading into the weekend. People talking about jobs numbers, but just stay the course here with the market and listen to the price action in the charts. This is one of my favorites. I wrote about this yesterday in my note that goes out to subscribers on Thompson 2 cents. It's free. You can reach out, or I believe we'll try to link it in the chat, but I posted to my Twitter at Hostile Charts. But I wrote about retail because I think retail is one of those areas that everyone has anecdotal evidence about. They have their favorite cousin and their uncle over Thanksgiving having conversations about my recent trip to the beach and how their recent trip to the beach, it was dead, right? The consumer's dead, or someone will post a photo of the mall being busy or the lines at the movie theater. The reality is anecdotal evidence is great, but it's not a process, right? It's just not a repeatable process that you can make money executing on. There's one guy who did it well, Peter Lynch, but he had a lot more variables involved. And I think people just think they can walk through a mall and become an expert investor like Peter Lynch. So look at a chart of XRT. You don't have to take my word for it, right? This is just price action on a chart with very little edits. try to keep the charts clean because price is what I trust, not my drawings. So what we have here is XRT. It makes up about 90 retail stocks equally weighted. We have things from food retailers to consumer staples to electronic retail, automotive retail, apparel retail, broadline retail, right? O'Reilly Auto Parts is in this, Ulta Beauty is in this, Signet Jewelers is in this, Walmart is in this. So it's a very diverse range of retailers. And they closed at new 52-week highs today, multi-year highs today for retail and retail ETF. So why would the market give us a message of 90 retail stocks equally weighted closing at new multi-year highs if the consumers and economy is in so much danger? Wouldn't that mean people wouldn't be spending money in retail locations? Right? Just you got to think through these narratives that men create and the price action and the message that the market creates. And you have a choice of which one you trust. Do you trust the narrative of men, which if you study history has been a faulty one, or do you trust the message of the market, which when you study history is right way more often than it's wrong? Choice is yours. I think you're watching this because you believe in the price action and the wisdom that it brings. So, like I said, retail, another sign that times are just fine. Next chart I wanted to look at, TLT, Treasury, right? You think about the message within the Treasury notes in terms of yields, right? And yields breaking down here a little bit, right? So bonds ripping. And one of the things I would say is you have to take that rule versus exception approach, right? So you take your weight of the evidence, right? Say you have 10 items, right? Give each one, assign it a weight of 10, right? So 10, 10, 10, 100. You add up 100, right? So if it's greater than 50, that means that more weight of the evidence is towards the bulls than the bears, right? So yields breaking down, right? And bonds kind of breaking out here can be seen maybe as bearish. Okay, so we'll put one thing in the bearish camp and we have 9 in the bullish. Weight of the evidence is still bullish. I would also just tell you, you could buy bonds. I think people get confused by that. And so what they try to do is then they try to sell their tech and then put on a pairs trade of shorting biotech because biotech is going to correct and I'm going to short retail because now the consumer is going to be weak. You could just stay long those areas and then maybe add some bond exposure because if you think the economy is going to collapse and the Fed's going to have to really lower rates quickly, well, you can also just have that exposure. And then if, right, you see retail breakdown, you set a trailing stop. And if it doesn't, you don't get out. And then if this continues to work, maybe they both work for a period of time, which can happen in markets because correlations aren't perfect 100% of the time. So even if there is a bearish chart, I wouldn't consider this one bearish, but if there is, we can still watch it and follow through, or we can buy it because a lot of things, the market has nuance. A lot of things can happen all at the same time. So next charts I want to go into are risk ratio analysis, right? So looking at risk on versus risk off, putting one in the numerator, one in the denominator. And what I do with my charts to try to make the message even clearer is instead of just having this middle panel, I see a lot of people just share the middle panel of high beta versus low volatility. I would like to look at both so I get the context of the other price action, right? Because sometimes one chart could just have a really good month and the other one could be doing pretty well too, but one's just accelerating, right? So you see the relative trend kind of accelerate. But what I see here is I see high beta is in the numerator and then low volatility is in the denominator. So think offensive risk on versus, right, maybe risk off, a little defensive. So we see this high beta chart just continuing to rip. And we see low volatility doing okay. It's trading sideways. So what that tells me is both investors are doing fine. There's not an area that neither area of this market is just completely falling apart, which is what you see in bull markets. You see investors even in underperforming assets making money. That's the message here, right? We have both of these in kind of uptrends, right? Right? And then we have the actual ratio in an uptrend. So the message here is that, right, having that higher beta exposure is paying off versus low volatility. And so when you think about low volatility, the names you want to think of, I'll pull it up real quickly for you guys in terms of what kind of exposure is in low volatility. So 21% of the weight in low volatility is utilities, financials, and then consumer staples, then industrials and real estate and healthcare. And so, right, utilities, financials tend to be a little bit lower volatility, have a little bit of the exposure relative, lower PE multiples in general. Same thing with consumer staples. And then the high beta side of this equation, so SPHB, pull up those holdings real quickly. You have information technology, right, or XLK, which makes up 33% of the market, which when that's doing well, there's no reason to be bearish. Then you have financials, consumer discretionary, industrials. So in general, more cyclical, right, areas of the market, more optimistic areas of the market, right, whereas low volatility, less so. But this ratio looks good. The message in the market here is that there's nothing yet to be worried about. These ratios, as you can see, right, early to start the year, it began to fall apart and it let us know. So I think oftentimes, especially from a human psychological perspective, what can happen is we can think, because we haven't studied history, that there's some information that bear knows that's not being reflected in price, which could be true. But the only way that bear is going to make money is if it eventually is reflected in price. And the only way you're going to lose money is if it is eventually reflected in price. And if you manage risk, when that time does come, we will know. And I will be on this show telling you that, hey, you know, high beta versus low volatility is starting to break down. We should maybe be looking at reducing risk, but that's not the case yet. Price will let us know. Next chart, similar, right? So we have equal weight consumer discretionary. So offense in red, defense in blue here. So equal weight consumer staples, equal weight consumer discretionary. Think Amazon, Tesla, home builders, right? Areas of the market that do well when the consumer and economy are doing well. Consumer staples, I'm buying toilet paper no matter what, right? I remember my parents, right, didn't come from a privileged household, unfortunately, but 2008, when my parents had issues with our home, they still bought toilet paper, right? But they didn't own a home during that time, right? They rented a house, right? So people will still be buying toilet paper and cereal. We still had toilet paper and cereal in our houses. We just didn't have, you know, fancy toys and gizmos and gadgets, and we weren't building and remodeling our kitchen. So Home Depot, Lowe's, those types of names. Look at those charts. Go through those charts this weekend, and they look great. And so what do you see? You see this ratio at year-to-date highs, at multi-year highs. Once again, look back in February. We started to see this ratio roll over. Price will let us know. So for now, price is saying stay with the underlying trend. Trust the market. Don't trust the narrative of men. And this is if really, guys, I only needed to bring one chart today, and this would have been it. Okay, so I'll break this one down. So we have the market of stocks, because when you think about, people talk about the stock market, a lot of times they're referring to the S&P 500, which is market cap weighted, so very heavy towards tech, which is great, right? It's a momentum fund. Momentum is a really robust market factor that's done well over the course of history, hence why it's so hard to outperform the S&P 500. And then that's this middle panel, right? We also have New York Stock Exchange, which has thousands of stocks on it. NASDAQ Composite, thousands of stocks on it. NASDAQ 100, we're familiar with. S&P 100, the largest 100 stocks in the S&P 500. And then S&P 400 is your mid caps. Okay, so those are smaller than, don't make it into the 500, but they're larger than the S&P 600, which are your small caps. And so the 500, 400, and 600, those all combined make up the S&P 1500. So once again, if we talk about anecdotal evidence versus market breadth, right, using the weight of the evidence approach here, we're looking at 1,500 stocks here in the S&P 1500. We're just going to use that in this example. You guys kind of understand how this chart works. So what we're doing here is looking at these indexes and their percent above key moving averages. So we have short-term trend on the left, and then as it goes, it gets to the longer-term trend. The longer-term trend, more significant. Think about, these are the cruise ships, right? They take a long time to turn. These are the little dingy speedboats. And these trends are the ones that we tend to want to be invested in as trend followers. They're the ones that are, this shows the real strength of the longer term trend. this can kind of be, that intermediate tactical time frame people will talk about. Well, we see a lot of green on this chart because looking at the S&P 1500, you have 70% of stocks above their 20-day, almost 70 above their 50, almost 70 above the 100, and 65 above the 200. So we have the majority of stocks above not only their short-term trends, but their long-term trends. And I would even just highlight in this above 200-day, we have room to the upside. These aren't readings of 90. It's not like every stock is above their 200-day. It's not like everything is extended from its 200-day. We have plenty of stocks that we can continue to see rotation into, like those home builders, like those biotechs, right? We have areas of the market that can continue to work higher here. And this middle panel above the 100, I think, is a great reflection of kind of that transitionary period, right? Are we seeing the 50-day lead into the 100 and then lead into the 200? And this guys, this is the opinion of 1,500 stocks here, right? And then up here we have the opinion of thousands of stocks. And so this symbolizes the message of the market of stocks. Every single one of these stocks is getting an individual vote, and the vote is that the majority of them are not only above their short-term trend and intermediate-term trend, but they're above their long-term trend. And we don't want to fight that message. We don't want to fight that trend. It just doesn't make sense, right? This will start to break down. I'm sure if I looked back at February numbers, these were in red and these were in red, but we're actually making year-to-date highs in a lot of this breadth work here. So once again, you have the narrative of men, the message of the market. Choose wisely. Last chart here, I just wanted to bring, just FYI, I'm not going to go through a bunch of individual names today. I'll be doing that in my Sunday stock list. That's where I share a lot of my individual setups. The point of today was to show you guys how you can use technicals and charts you can use to understand the message of the market. But I will just point out one here. Just looking at IBIT, right? Bitcoin. And it's starting to pull back, right? You have this base on base breakout, right? Underlying uptrend. April low AVWAP here kind of served as support. We're kind of running it here again. I think this is a opportunity based on the message of the market that risk is being rewarded, that you could add exposure. Another beauty of technical analysis is that we will quickly know where we're wrong. If we get below 60, it's probably something you avoid, and we probably start to see other charts that are at key support levels breaking down. But overall, I think Bitcoin is an area that looks pretty good here. I think this is the opportunity when people talk about how do you buy a pullback. You buy strength after it. So we had an update today. If we see some follow through here in Bitcoin, I could see that being a good thing. And one of the ways to play it is via IBIT, something you can buy in your Roth 401k. This isn't financial advice, but something that has a ton of upside. If you buy it inside of a Roth, you don't pay capital gains tax on that because you've already paid your taxes. So if it doubles, right, that's not something you're going to get taxed on. So IBIT, an individual chart, and then now I'll kind of get into some of the chart requests that people had from the week. Appreciate the chart requests you guys send in every week. I'll try to review those at the end of the show. And like I said, I'll go through these live as we speak. That way you guys can kind of see my process. So I'll go through these and then I'll answer a couple questions in the chat. Shout out to the people in the chat today. Good to see you guys. So let me pull up. Gene, I'm going to pull up charts real quick. I don't think I have anything here. It's okay if people see the whole screen. So Hood, first chart. So I tend to start just with a zoomed out view of a chart. Okay. And so this top panel is RSI, which is that momentum. And then this middle panel is price. And then bottom panel is a relative trend. So you have Hood over the S&P 500. And then that's the 50-day moving average. You can see Hood is losing some of its relative strength. Don't like to see that. But you're seeing it's kind of putting in a floor here around 100. So what I would do here is I would just try to define my risk in something like this. So just draw a quick line right around that $100 level in something like Hood. So you can kind of see it's formed this like fake top. It's really a consolidation if the underlying trend is as strong as it is. So something like Hood against $100, I think you can be long here. I think it probably, if the market is going to stay a bull market, this probably isn't breaking down to the downside. I would just probably set my stop around this low of 92.98. That's probably where I would set my stop. So try not to clear this low from that time frame. Another way to look at this, if you have a little bit longer of a time frame, is you can add an anchored VWAP from the low in April, and you can kind of see it's going to give you a lot more room to run. We kind of see that 79 level is something, or you can do it from this pivot high, which is around 69. So Hood overall, it's consolidating above support, right? This looks a lot like a lot of tech right now, just consolidating above support. We would want to see the actual breakdown before we got too worried about a name like this. So good one. Next one from Carol. Bravo. Finally, some that actually talks about stocks. Could you show NEU for the next 6 months? NEU. Let's pull that up. Shout out to Carol. Material specialty chemicals. Beautiful. This is just a beautiful chart. So we can zoom out here. I'll actually do a weekly because she said like 6 months. So we'll zoom out. Carol, this is a good looking chart. Let's remove this. Beautiful. Beautiful base breakout in NEU. Specialty chemicals. You guys see that? Nice breakout. And I think you just set a trailing stop, right? We had what is a shooting star pattern this week. It's where the top candle kind of opens and it drags down. But overall, it's still a good looking chart here. So NEU, yeah, stay long, set a trailing stop. Let's zoom in a little bit. Yeah, you're fine. You're fine in a name like this. Maybe run an anchored VWAP from here, right? 750. That gives you some downside. Decent amount of downside, right? 7-8%. That's probably the area. If we got below that, I would probably get out in NEU, that 740 area. But overall, probably just going to consolidate sideways. It was overbought, right? You kind of saw that consolidation back here. So I wouldn't, in something like this, you might get that pullback. But thanks for the chart, Carol. Thanks for the shouts. I appreciate it. And then really like how you go through chart requests, sharing your steps on how you approach charts. Thank you, Alpha 8587. Crowd and HSAI. Crowd is a chart, if I did have a worry in the market, it is the way some of these software charts look, if I'm being honest. I don't like the way some of these software charts look, and Crowd is one of them. This is already edited, but I'll kind of explain it to you guys how I walk through it. So I have the 200-day, just a longer term moving average. I anchor VWAP to the March low, and I see it's funny. It's funny how price works because I did this prior to this, but we had earnings, gap up, huge candle in earnings, and then we're seeing follow through back down to the 200-day. If you believe in something like Crowd from a fundamental perspective or cybersecurity in general, I think you buy this all day. I think you buy this all day against this 417, 410 level. I think you buy against 410 and you set your stop at the most recent lows or even this, right? You could set your stop. I use chandelier exits, which you guys can look that up. Essentially, you incorporate volatility into a trailing stop. But if we're looking at this, let me draw a quick across here. We kind of have support here. So as long as we're above 400, I would probably buy this all day if you're a longer term investor. As long as we stay above 400, I think CrowdStrike's a buy. It's tough, right, to think about it like, oh, it's not trending like other stocks. But if we listen to the message of the market, this area is probably eventually going to see rotation again. And CrowdStrike is just a leader and secular leader in that space overall. So good spot. Thank you for that chart. HSAI was the second one. So this is an electronic equipment company. Oh, you guys are bringing some fire charts. I just wanted to zoom out a little bit. I love this. I absolutely love this chart. Let me fill the chart. This is beautiful. Beautiful, beautiful base breakout. Look at this rounding bottom. Looks like something that happened in Palantir. This is a weekly chart. You got to stay long this space. Got to stay long this chart against 20, 22, 23. Look at that. Huge base breakout, right? Probably plenty of room to run to the upside in a name like this. I like HSAI. Good looking chart there. So HSAI, let's take a quick peek. Technology equipment, about a $3.5 billion market cap, right? 300 million in sales. So it's a real company. I think in general, this space looks great. Look at an ETF like PAVE, PAVE, right? Infrastructure development, similar looking idea. Right, this is a weekly chart, but you can see that base breakout here. I'll zoom into the daily and you see it a little bit better. But you have this base and then breakout sideways, right? You're seeing this everywhere in the market. You're seeing a ton of areas in the market that look like this, right? Trading, consolidating above prior cycle highs. Beautiful looking chart here. So good chart requests from the chat today. So let me go down here and I'll answer a couple questions in the chat. So one hole, can you show historical comparison before bear market? What were the percentages in comparison regarding above X day charts? Why are some of your candles hollow, body filled, or I mean the blue ones? So yeah, I use hollow candles, which just highlights if a stock is higher than its low from the previous day. That's what the like candle symbolizes. You'll kind of see it here, right? So it gets filled. Right, the candle gets filled. Let me slideshow this so it's a little bit bigger. So I'll show a quick example. So if we look here at April and you have this huge blue candle. So the open is the bottom, the close is the top, and see it's hollow because that's the open was lower than the close, right? And then you see these full candles when it's the opposite. So the open was here, the close was there, open was here, close was there, open was here, close was there. So that's kind of how those work. So the reason you'll see a hollow candle like this that's red is when you see these gap downs, because you'll see a gap down, but then the open was lower than the high. So it takes the previous day. So if it's higher, no matter what, it's going to be red or blue. And then if the open is higher than the close is going to determine whether or not it's hollow or solid. So here you see open, close, open, close. So that's kind of how the hollow versus solid works. But you don't have to overthink that. It's not the end of the world. And then there was a question about historical comparison of percent above regarding percent above chart. So I'll show you this chart. Okay, so he's talking about the table I showed. I don't have that data in front of me right now, but I'll show you this chart. So if you look here at the start of the year, we broke. So part of it is where are you coming from? So the percent above their 200-day, we broke below 60, but we were coming from above it. So we knew breadth was weakening. So we had sideways price action and weakening breadth. Okay, so price action was giving us a neutral message and breadth was giving us a negative message. And then we saw downside follow through. Right now we have positive overall trend and strengthening breadth. Okay, that's how you kind of got to think about it. You'll see back here during the top in 2022, you can see also that 60 is kind of that threshold. Got below it from above, price was consolidating, and then we broke down. Right, and then broke down, broke down, broke down. So that's kind of how you can use it. But you'll see that when you look from historical perspective, breadth doesn't tend to diverge from price too much. I would also recommend one hole. Go watch my video about the Achilles heel of the S&P 500. It's going to be on this channel. And I talk through a little bit some of the nuances of breadth. I'll do a whole separate breadth video actually to kind of get into some of those nuances too. But watch the Achilles heel video and I break that down a little bit. So good stuff. That's all I had today, guys. I appreciate all the comments. Appreciate all the love. Go easy on my charges tonight. Have a good weekend. Thanks, Dominic. Guys, check out my work. I do Saturday, right? I'll write a blog tomorrow for you guys to read. That one's a little bit more in depth. And then Sunday is my favorite writing I do. It's the Sunday stock list. Every week I send that out. You can find it on my Twitter and sign up there. But essentially, I break down individual charts that I'm looking at for the week ahead. And those are the individual setups I like. That's where you'll see a lot more tactical analysis from me with not a lot of commentary. I leave my commentary to this show. So love you guys. Have a great weekend. Go Chiefs.